Hey everyone! Welcome back to our channel. If you're new here, don't forget to hit that subscribe button and give this video a thumbs up. Today, we're diving into an essential topic in the world of decentralized finance, or DeFi specifically, the concepts of ambient liquidity and custom liquidity in decentralized exchanges. Whether you're a seasoned trader or just getting started in the crypto space, understanding these concepts can help you navigate the DeFi landscape more effectively. So, let's get right into it. But first, you might be wondering, what exactly do we mean by ambient liquidity and custom liquidity? How do they differ, and why should you care? Let's break it down. To start off, let's define what liquidity means in the context of DEXs. Liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. In simple terms, higher liquidity means you can trade assets quickly without worrying about drastic price changes. Now, when we talk about ambient liquidity, we're referring to liquidity that exists naturally in a market, often facilitated by automated market makers like Uniswap or SushiSwap. These platforms allow users to provide liquidity by depositing pairs of tokens into liquidity pools. The ambient liquidity becomes available for traders to access at any time, creating a seamless trading experience. Let's say you want to swap Ethereum for USDC. In a DEX with ambient liquidity, you can simply go to the liquidity pool where ETH and USDC are paired. Because many users have already deposited their assets into this pool, you can quickly make your trade without having to wait for someone else to buy or sell. According to recent statistics, platforms like Uniswap have billions of dollars in liquidity across various trading pairs, making it one of the most liquid decentralized exchanges available today. This ensures that traders can execute their transactions with minimal slippage, which is the difference between the expected price of a trade and the actual price. Now, let's move on to custom liquidity. This is a bit different. Custom liquidity refers to liquidity that is specifically created or allocated for particular trading strategies or assets. This often involves users or liquidity providers setting up their own liquidity pools, typically with unique parameters tailored to specific trading needs. Imagine you are a trader who wants to establish a liquidity pool for a new token that you believe in, a token that isn't yet listed on major exchanges. You could create a custom liquidity pool for this token and pair it with a more established asset like Ethereum or USDC. By doing this, you're not only providing liquidity for users who want to trade this new token, but you're also positioning yourself to earn trading fees from that activity. Custom liquidity allows for flexibility and specialization. For instance, if you're a market maker with insights into certain trends or projects, you might want to allocate your resources to pools that align with those insights. So, how do ambient and custom liquidity stack up against each other? Here are a few key differences. 1. Accessibility. Ambient liquidity is readily available to all traders on a DEX, provided by the community. Custom liquidity, on the other hand, is often more niche and can be tailored for specific trading purposes. 2. Control. With ambient liquidity, you have little control over the parameters of the liquidity pools. In contrast, custom liquidity allows you to set specific parameters, such as the liquidity ratio or the fee structure. 3. Risk and reward. Ambient liquidity typically involves lower risk for traders since it's established and has a proven track record. Custom liquidity can carry higher risks, especially if the new token doesn't perform as expected. However, the potential rewards can also be greater, particularly if you're an early investor in a successful project. A recent study showed that liquidity providers in custom pools can earn up to 10% higher fees compared to those in more established ambient pools. However, this comes with the caveat of increased risk due to the volatility of newer tokens. So, to wrap things up, understanding the differences between ambient and custom liquidity can significantly enhance your trading strategy on decentralized exchanges. Ambient liquidity provides a broad, accessible trading environment, while custom liquidity offers flexibility and the potential for higher rewards at greater risk. Now that you're armed with this knowledge, it's time to dive into the world of DEXs and explore how you can leverage both types of liquidity to your advantage. If you found this video helpful, please give it a thumbs up, share it with your friends, and leave a comment below with your thoughts or any questions you might have. Don't forget to subscribe for more educational content on DeFi and cryptocurrency. Until next time, happy trading and see you in the next video.